Copays and coinsurance are two ways health insurance asks you to share costs. The pattern shows up when a copay is usually a fixed amount, while coinsurance is a percentage. The moving force is that the difference affects what you pay at clinics, pharmacies, and hospitals. The risk is that confusing them can make a bill feel surprising. A copay is predictable. In a daily situation, a plan might charge a set amount for a routine doctor visit. The link is that the amount is known before the visit in many cases. Once that link matters, predictability helps with small recurring care. Coinsurance changes with the total bill. The clearest example is if the covered cost is large, a percentage share can also be large. The explanation starts with 20% of a small lab test is manageable, but 20% of surgery can be serious. The consequence is the total price matters. Copays often apply to common services. For example, primary care visits, specialist visits, urgent care, or prescriptions may have listed copays. The reason is that the plan document decides which services use them. That can mean a familiar card amount does not apply to every type of care. Coinsurance often appears after the deductible. In real life, many plans require you to pay the deductible first, then share costs by percentage. The pressure comes from this. The timing changes your out-of-pocket burden. The result can be two people with the same procedure can pay differently depending on deductible status. The deductible is separate from both terms. Think of it as the amount you pay before certain coverage starts. The process works because copays may or may not count toward it depending on the plan. Over time, reading the benefit summary prevents wrong assumptions. Network status affects both costs. A simple case is this. An in-network doctor may have a lower copay or lower coinsurance rate. The important driver is that out-of-network care can cost much more. That is why the provider choice can matter as much as the medical service. A specialist visit may not cost the same as primary care. You might see it when seeing a dermatologist or cardiologist can carry a higher copay. What matters underneath is that plans price services by category. If it is ignored, patients should check the category before booking. Prescriptions have their own tiers. One ordinary version is a generic medicine may have a low copay while a brand name drug costs more. The mechanism is that formularies sort drugs into cost levels. The practical effect is the pharmacy bill depends on the plana Euro S-tier rules. Coinsurance can be difficult because prices are hidden. Consider patients may not know the allowed amount until the claim is processed. The hidden part is that a percentage is hard to budget without the base price. The outcome is often that estimates help but may not be final. The out-of-pocket maximum limits the Euro S burden. After reaching the out-of-pocket maximum, covered in-network care may be paid differently by the plan. The moving force is that this protects against endless cost sharing. The risk is that the limit usually applies only to covered services under plan rules. Emergency care can still create confusion. In a daily situation, different doctors, facilities, or services may bill separately. The link is that one hospital visit can produce multiple claims. Once that link matters, copays and coinsurance may appear in different parts of the same event. Preventive care may be treated differently. The clearest example is some screenings or vaccines may have no copay when rules are met. The explanation starts with coding and network status still matter. The consequence is patients should confirm before assuming every preventive-looking service is free. The explanation of benefits shows how the math was applied. For example, it lists billed amount, allowed amount, insurer payment, and patient responsibility. The reason is that this document helps separate copay, coinsurance, deductible, and denial issues. That can mean it should be reviewed before paying a confusing bill. A low copay plan may have higher premiums. In real life, predictable visit costs are attractive, but monthly cost may rise. The pressure comes from this. The right choice depends on how often care is used. The result can be someone with frequent appointments may value predictability more. High coinsurance risk matters for major care. Think of a plan can look cheap until a hospital bill arrives. The process works because percentage sharing becomes expensive when the underlying cost is high. Over time, people with known medical needs should compare worst-case costs. Questions before care can prevent shock. A simple case is this. Ask whether the provider is in-network, whether the deductible applies, and whether the service has copay or coinsurance. The important driver is that the answer may not be perfect, but it reduces surprise. That is why documentation of the call can help later. Copay means fixed share, coinsurance means percentage share. You might see it when that simple difference is the foundation. What matters underneath is that the real bill also depends on deductible, network, allowed amount, and annual limits. If it is ignored, all pieces must be read together. The smartest comparison uses scenarios. One ordinary version is estimate a routine year, a specialist heavy year, and a hospital year. The mechanism is that the better plan is not always the one with the lowest premium. The practical effect is cost-sharing design matters when care becomes real. Copays and coinsurance becomes clearer when it is tested in ordinary life. Take fixed doctor visit copay. The point is visible in a fixed doctor visit copay. The choice changes because copays and coinsurance changes the pressure around the decision. What matters is the real consequence for the people involved, not just the clean definition of copays and coinsurance. When the example is concrete, copays and coinsurance stops sounding abstract and starts looking like something people deal with in real conversations, bills, deadlines, and relationships. Another useful angle is 20% hospital coinsurance. A percentage share after surgery shows how one background condition can change the outcome before anyone calls it a big event. For copays and coinsurance, the hidden force is how the bill is split between a fixed amount and a percentage. Once that split is clear, a doctor visit and a hospital procedure no longer feel priced by the same rule. The difference matters most when a bill arrives, because a fixed copay and a percentage-based coinsurance can feel very different at the cash counter. A weak reading assumes insurance pays everything after the card is shown and misses cost sharing. In the case of deductible met before sharing starts, the final result may look simple from the outside, but the pressure was already building before anyone noticed it. Better judgment starts by checking whether the plan uses a flat fee or a percentage for that service. A practical example is specialist visit costing more. The practical point is not to memorize a slogan about copays and coinsurance. The practical point is to estimate your share before care whenever the situation allows it. That contrast explains why a small visit and a large procedure create very different bills. Most confusion around copays and coinsurance comes from missing that hidden exchange and focusing only on the surface event. Copays feel predictable because they are fixed. Coinsurance is more uncertain because it depends on the bill size. A final example, medical bill split after insurance, shows why this matters before the outcome becomes expensive, stressful, or emotionally charged. The strongest takeaway is to know whether your share is fixed or percentage-based. The practical point is to estimate your share before care whenever the situation allows it. Once those parts are visible, copays and coinsurance becomes less mysterious and much easier to handle in daily life.